Hello traders, Gary Wagner here, just about 10:30 in Honolulu, 4:30 in New York. It's Monday, July 11th, 2016, and this is the Daily Report for Gold and Silver. After trading moderately higher in overseas trading yesterday, Sunday, of course, here in Hawaii, as well as mainland USA, we did see gold succumb to pressure and actually close lower on the day. COMEX futures, this is the August contract, 1356, putting it down about $2 on the day, the low 51 and the high 1376. We'll take a quick look at Forex, or what we call spot gold, 1355, putting it down about $10 on the day with a low of 51 and a high of 1375. We did issue a trade alert yesterday as the market broke to new highs. Traders taking that call got in at roughly 1371. However, it became apparent and relatively quick fashion to me that this trade wasn't, in my opinion, going to pan out. I pulled the trigger in terms of taking the stop to the market, sent out another trade alert because my sense was that if, in fact, this market was going to head lower, we've had such a superlative track record through this year. I certainly didn't want to give too much back. Traders got in roughly at 1371, got out at 61 in that area for a loss of about $10 on the trade. Of course, I'll show you when we look at our first chart as to what really predicated me pulling the trigger to exit that trade so quickly. We'll do that all on today's Daily Report. So traders, there's absolutely no doubt I pulled the trigger on a buy signal yesterday, but quickly felt uncomfortable with the trade as the new highs we were seeing in the market didn't have the correct follow through. Now, we're looking at a daily chart and you can't really see the actual breakout and subsequent sell-off on this because, of course, it is a single candle, this red candle. What we can see is the fact that we can easily at this point identify some very strong headwinds, and these headwinds are really being created by a strong US dollar, but they come in roughly at 1371. Interestingly enough, that is a 1-to-1 relationship between wave 1 and our current wave 3. Now, you can see that on the last 4 trading days, we have touched these highs at 71 and not been able to break above that. However, on 2 occasions, meaning yesterday's trading, or I should say today's trading, this red candle here, as well as this candle here that would have come in Wednesday of last week, actually did flirt and trade above that for a little while. And to illustrate what I'm talking about, let me go ahead and pull up a half-hour candlestick chart. And traders, we're looking at a half-an-hour candlestick chart. You can see the incredible volatility that, of course, came into the market. This, of course, when the jobs report was released, is tremendous low down to 36 and subsequent recovery. Now, as the market opened overseas yesterday, we saw this market have a dynamic play as it moved to higher ground, and there were a couple of key areas that I was looking at. The first key area that I was looking at was 64, and then most importantly were these series of tops right in here that come in terms of a price point roughly at 1371. And so when the market genuinely broke out and traded above that price point, and that occurred right here, that was my trigger to enter the market because a breakout to the upside would signal yet another leg of this rally if we had seen some follow through. Now, with that in mind, I did issue the recommendation, but I saw the market quickly coming under pressure, and as such, I did not feel comfortable with the trade. I've been trading for a long enough period of time that there are just times when you have a trade that you've just put on that you realize is not the appropriate move. It doesn't feel right. And so in this case, simply what I did was send out another trade alert when the market was about $10 lower at 1361, and advised all subscribers to take a small hit in the market, in at 71, out at 61. We are currently flat in the market. And so what that really brings up, our next topic is, well, what from here? How can we take this new data point and kind of put it into our model? And then the first thing that you'll see is that my sense is we could still absolutely be deeply involved in this third wave. Now, we've already met the criteria. We've got that one-to-one relationship between wave 1 and our current wave 3. But the way that I'm looking at it is something like this. We've got the conclusion of our wave 2. And so what I'm looking at is we'll probably see this market back off. My anticipation is it could go as low as about either 1346 or 1326 and be another wave down, and from there we would get our last wave up. And I still believe that the market should achieve on this particular impulse wave. It's already achieved the one-to-one. So if this is the end of it, which I personally don't think so, I'm talking about wave 3, then we'll get that wave 4 and a final wave 5, and the wave 5 is going to take us between 1400 and 1445. However, what I believe is more likely at this point is simply something like this: a 1, a 2, our 3 is going to be composed. We could break this down further, but we'd need to go to a intraday chart. But in essence, to see the market back off a little bit, as I said, either to 46 or to 26, and then break back through there, going to 1.23% or $1,400 per ounce. That's the current model that I believe has the highest probability of unfolding. We'll have to see what happens. But as I said, I just did not feel comfortable with that trade once we put it on, and I'm not going to watch a trade go against us if we had a failure to have that follow-through rally once we went to those highs. And that was the primary reason we bought, is because it broke above 71, and the primary reason we covered quickly was because it couldn't sustain it. This has been Gary Wagner, wishing you, as always, good trading. We will talk to you tomorrow for another daily update and review. Bye-bye.